Good morning. This is another in a series of explainers from two gray beards. Today I woke up and felt I had to record this explainer. And the topic today will be, what are deposits? Seems like an easy question, but in the context of the bank runs that have occurred and the very high interest rates that other forms of savings receive nowadays, including bills and money market funds, and the general crisis where some banks have become insolvent and seized, it probably makes sense to see how these things all work. So I'm a little obsessed with this, so I'll just give you my thoughts. Okay, so in our current monetary system, the one that's been around for a long, long time, cash, physical bills, and coins are still used. I use them every day. Well, not so much anymore, actually, but use them. But those aren't the way most transactions occur. Most transactions in our economy are a transfer of a deposit at a bank that I own to the merchant or service provider that I want to buy something from, to their deposit account at my bank or at another bank, but somewhere in the banking system. Even when I buy, or the government buys, or the private sector generally buys a good from China, we transfer a deposit from our account at a bank in the United States to a bank that in the United States that the Chinese merchant, seller, or government owns. Nothing changes. The money doesn't actually go to China. Our deposit gets moved to a deposit in another bank that is in the United States. At that point, the depositor can move their deposit outward, but I want to focus on, because the foreign flows are beyond the level that I want to talk out. So I'm going to just assume that we're talking about U.S. commerce within U.S. borders with U.S. participants. So I know most of you think a deposit is cash. It really isn't. It's credit, meaning you're counting that when you write a check on your deposit, or you transfer your deposit via Venmo or Zelle or a bank ACH or a wire or any form of electronic transfer, that the person that receives that deposit transfer accepts it as cash. And they do. That's the way things work. So let me just take a transactional thing, and then we'll get into the, why deposits matter in the banking system and so on. But just in the transactional sense, let's say I pay for a burrito at Chipotle with my credit card. So how does that transaction work? Well, my credit card provider creates a deposit in the bank of Chipotle, and I get my burrito. Fine. For my sake, I'm done. From Chipotle's sake, they sold a burrito and they have a deposit, so they're good. But then a month later, my credit card bill comes due and I got to satisfy the credit card company. So what do? I transfer my deposit to the credit card company's deposit, and the credit card company is now whole because they sent a deposit to Chipotle and they received a deposit from me, and everything's all good. All the transactions have settled. And that's how our financial system works, sometimes instantaneously, like a debit card literally transfers the deposit instantaneously. Venmo and Zelle transfers the deposit instantaneously. Venmo, I don't know if they actually receive and create deposits themselves at their own Venmo bank. But anyway, the point is that transactions for goods and services work by the transfer of deposits from one owner of the deposit to another owner of the deposit. And it doesn't matter what bank each of us are banking at, where we keep our deposits, the banking system has no change in its deposits. So conceptually, I think it's useful to think of the banking system as a single bank, single private bank, not the Federal Reserve, a single private bank. Now, currently, single banks are failing. So it's not, when I'm discussing the banking system, I'm not saying that any particular bank can't get in trouble if its deposits leave. If all of its deposits leave, a bank is illiquid and can't satisfy that. It's literally a run like you saw in the movie It's a Wonderful Life, or you studied the Great Depression, or you've just looked recently at Silicon Valley Bank. In order to transfer deposits, banks have to do something. And so we'll get to that. And sometimes they can't do that thing they need to do to transfer the deposit. And in that case, the bank run has occurred and the bank becomes illiquid and may, in fact, be insolvent, which has been the primary case here. So that's the transactions. Now we're going to come to the banking system and deposits and the alternative for deposits. So if you have a deposit at a bank, you have a set of alternatives, and you compare the convenience, the interest received or not, and the safety of that deposit at that bank when you are considering your alternatives. If you have FDIC insurance, meaning you're below the 250,000 limit, the safety thing should be ignored by and large. If you have a higher interest alternative, well, you may walk to that higher interest. And my friend Jim Bianco calls that the bank walk. Higher interest causing deposits to seek that higher interest. And we're going to go through that flow because it's not as simple as it sounds. Okay? So here I am with these options to, I've dealt with the safety one with the FDIC. Then there's the convenience one. And one of the options for money is to buy T-bills. T-bills mature at earliest 7 days in some cases, but usually about a month. And when you place your cash in T-bills, which is safe as can be, this recording is happening during the debt ceiling issue, so we'll see how safe, but probably safe. The purchase of a T-bill creates a convenience problem for you that a bank solves, in that it's not simple. In fact, it's almost impossible to buy a burrito with a T-bill. You have to convert it into a deposit by selling it. And by the way, Bitcoin is a similar example. It's hard to pay for a burrito with Bitcoin. So what happens is you sell your T-bill, you put it in a bank, and then you transfer the deposit, like I said, and you have your burrito. So there's a convenience factor that says, I'd rather keep my money in the bank instead of having to transact in the savings vehicle I have to buy a burrito. Now, money market funds are a good alternative, and they've been able to, you can write checks off your money market account, and the liquidity available in the current government-only money market funds, something called 2a7 funds, is very liquid. And so conceptually, the money market fund industry should make their product as convenient as a bank account. But if you go on to your bank. And by the way, this applies to brokerage accounts too. Same thing. Some brokerage accounts have gotten very good at being transactional and offer higher interest. But what's important is that the convenience of a bank for now is superior. And so lots of people keep their money in the bank because they're willing to pay for that convenience by not receiving interest on their deposit. So the last thing is the relative interest rate. And right now, the relative interest rate for money market funds and T-bills versus the standard rate that one gets at a bank is very compelling to cause deposits to seek those sorts of assets, savings vehicles, even though the convenience factor is a negative. So let's walk through that. If I decide to buy a T-bill and I transfer to the US government my deposit, now I have a T-bill. So I'm okay. I have a savings vehicle. I transferred one savings vehicle for another. It's very important to understand what happens to the banking system as in result of that transaction, as a result of that transaction. So the government now has a deposit. Now, the government doesn't keep it used to, but it doesn't anymore, keep its deposits in the private sector. Now it keeps its deposits at the Fed, the Federal Reserve. And so you're 100% right when you think that when you buy a T-bill, a deposit is destroyed because the deposit leaves the banking system and ends up at the Federal Reserve as a government deposit. They call that the Treasury General Account, or TGA. But the government doesn't save, the government spends. In fact, it has a deficit every day. And so that TGA is constantly being filled up by taxes, filled up by borrowing, which they can't do right now because of the debt ceiling, and depleted by redemptions of existing bills and spending. Now, we're going to focus on spending. So let's just assume that the TGA is always a net spender. Sometimes it gets bigger, sometimes it gets smaller, but in general, the government gets money from your T-bill that you just purchased and spends. So guess what they do? When the government spends, the government transfers their deposit to a person in the private sector. Okay, now let's flow through that and say it happens instantaneously. I buy a T-bill. My deposit exits the banking system, and then the government spends and hands that same deposit that I just spent, that I just destroyed, to somebody else. Maybe even me as a benefit. Who knows? But that deposit comes back into the banking system, so there is no change in the deposits of the banking system because I left the banking system by buying T-bills. That's sort of mind-blowing, right? I just walked away from deposits, but deposits didn't change. Can that last indefinitely? Well, yes, it lasts literally indefinitely without a few exceptions, which I'll go into. As I said, sometimes the government builds its deposit account, the Treasury General Account. And every time they build it, for a period of time before they spend it, deposits leave the system. Now, is that permanent? As I said, it's quite the opposite. The government, by deficit spending, is always increasing deposits in the private sector every day on average. Again, it swings intraday, but certainly over the last, gosh, as long as I can remember, and so I guess since 1996, when there was a brief period of time when there was a budget surplus, the government placed more deposits into the banking system than were withdrawn from the banking system. Mind blowing, right? Government spending creates deposits. Okay. So we've gone down the T-bill route, so there must be other routes. Well, let's start with money market funds. That's the most compelling alternative right now for holding your money. It has convenience, not as good as banks, but more convenient than T-bills. And it has higher rates. Sounds great. By the way, it's also very safe. Though there's no FDIC insurance, the assets you own when you own a money market fund are literally T-bills. And so you have claim on those assets, and there's nobody else with any other claim but the other shareholders, and they only are entitled to what they paid for. So it's very safe, and so that deals with the FDIC difference. So money market funds sound like a really good alternative. But let's talk about what happens. There is something called the reverse repo program, and I will come back to that. But ignoring that for the time being, I want to describe what normally happens absent that program when someone transfers a deposit to a money market fund and the money market fund acts like it normally does. So what does the money market fund do with your money? It buys T-bills. What is the T-bills? Oh, wait, we just talked about when some entity buys T-bills, what happens? So the money market fund takes your money, which exits the banking system, buys T-bills, which enter the Treasury General account of the US government, and then the US government spends it, and the deposit is reintroduced to the financial system. And so your deposit didn't leave the financial system because you happened to have bought a money market mutual fund. It stayed right there. Shocking, right? No, you can't, the banks can't lose deposits. They stay in the system. That's fairly mind-blowing, frankly. So, but that's how it works. You know, there's lots of different conversation on how things work, but it just I told you how it works. Does anything not add up to you? Does it change your frame of reference? Hopefully. That's the point of this video. Now, deposits can be destroyed and leave the banking system, but there's only one specific way that a depositor making a choice for an alternative leaves the banking system. I'll deal with the other ways that the banking system loses deposits, but that's not what we're talking about when we're talking about deposit flight and deposit runs and deposit walks and all of the things that are currently the fashionable discussion. We'll come back to them, I promise. But now we have to deal with the reverse repo program. And the reverse repo program is a program that was instituted when in March, well, it's been around for a long time, but it started getting big in March of 2021. At that point, there was so much bank deposits in the system because of the sizable fiscal spending that had occurred. Remember I said when fiscal spends, deposits grow. COVID had a large fiscal stimulus response, lots of spending, lots of deposits created. And banks holding lots of deposits was made a negative cost became associated with holding those deposits and the offsetting bank reserves that banks have to hold to offset deposits by a change in regulation. Actually, what it was a reinstatement of some regulation that had been in place for the prior year. And so banks didn't want deposits. Now, if banks don't want deposits, there has to be a place for that money to go. And as I said, without some outside vehicle, if banks say to a customer, hey, we don't want your deposit anymore, the banking system can't get rid of it because there's no place for the person to take their deposit. They take it to T-bills, the money comes back. They take it to a money market fund, the money comes back. So the banking system's stuck with the deposit. So the RRP program, reverse repo program, is a program on the Fed's balance sheet, which lets any of a set of people, money market funds primarily, deposit cash and earn interest on that cash overnight. Okay. So that's a way that the flow that I described can be averted. Money market fund gets cash from your deposit, places it in a deposit at the Federal Reserve. That deposit disappears from the banking system. And so that is an important way that deposits get destroyed when somebody decides to move their deposit from a money market fund to from a bank to a money market fund. The government destroys the deposit. Well, it keeps it on the Fed's balance sheet, but the Fed's balance sheet isn't the private banking system. So that's the exception. And so what I encourage you to do, and I will post a slide on this video, is look at the change in the reverse repo program, which has been very stable between 2.1 trillion and 2.3 trillion during this entire period of higher interest rates for competing with deposits. So keep an eye on that. If it grows rapidly, then yes, there's a lot of people that are looking for alternatives, and it leaves the banking system. But so far that hasn't happened. So to wrap all this up, the banking system isn't affected when you make this choice to, absent an increase in the RRP program, the banking system's deposits are not affected. The aggregate amount of them are not affected when you decide to move your deposit to a money market fund or buy T-bills. So the banks don't have any change in their deposits, so their behavior doesn't have to change. And in fact, if the new deposit that was created through the government spending channel that I described doesn't care about the interest, they don't care that you left for higher interest because the new deposit cares less about the interest than you did. Now, in reality, banks are not going to be able to keep the difference between what they pay and what alternatives pay forever. It's a pressure. If they don't respond to, and by the way, banks have always responded. It just takes a long time because when you change your interest rate for depositors, you have to change it for everyone. Now, you can change it if somebody asks, but if you universally say, I'm going to increase deposits by 1%, interest on deposits by 1%, there are a ton of depositors that are going to say, geez, thanks, I didn't even need that. So the banks slow play that because why pay the whole group? Just top off the people that are whining about it to keep deposits. And I don't mean to be coarse, but banks are in the business of earning money, and they're going to take as much as they can get without knowing that your deposits can't leave. they're going to take as much as they can get. And so they take their time in raising deposits. Now, individual banks that are facing stress are increasing their deposit rates faster than the banking system. Okay, so that's the whole picture. Now I'm going to deal with two things, a series of other things that people want to talk about regarding deposit destruction. And the first one is the normal activity of banks. So when a bank has a loan and that loan becomes due, and let's assume it's the banking system as a whole, when it comes due, the bank transfers your deposit that you have to pay off your loan. Now the deposit disappears and the loan disappears and deposits are destroyed. So that happens all the time. So if you pay attention to deposits based on loan maturities, not because the depositor wants to chase a higher yield in money market funds or T-bills, but simply because loans come due and are not reinitiated, deposits fall. Full stop. Now, every time a loan is created, a new loan is created out, that dynamic is the opposite, in that a new loan is created and a deposit is created, meaning that the person who borrowed the money can spend that deposit to buy his house. So the amount of credit creation each day, each year, has an impact on the deposit amounts that exist in the overall banking system. The other ways deposits leave the banking system. I mentioned that if the government decides to save your deposit and spend it later, that temporarily reduces the banking system's deposits. I mentioned the RRP. If it grows, that reduces the deposits in the system. The last thing is when the government issues a bond or bill and you buy it, transferring your deposit to the Treasury General account, and then the Treasury pays off the Fed for the bonds in their QE, which is called the SOMA portfolio, their portfolio of bonds that mature that day, the deposit is destroyed and eliminated from the banking system. I think that covers all the major points on the deposits, but I hope it helps you see that banks are not seeing deposit walks generating weak deposits, but they are facing costs when the whole set of depositors say, I need more interest. But that takes time. It doesn't stop a bank run, and a bank run is for a specific bank in the banking system. In the bank, when there's a bank run, it's because the bank may not be creditworthy. It may be insolvent. Its stock may be falling to zero. It may be about to be taken over. And bank runs result in a transfer of your deposit from the bank that's in trouble to another bank, or to the money market fund, which flows back to the banking system, or to the T-bill, which flows back to the banking system. But whatever you choose when you run, you end up in the banking system. Not the bank you had it in, but in a different bank, in one way or the other, whether it's you or whether it's the depositor that received the proceeds from your purchase of a money market fund and its purchase of T-bills. Super confusing, I know. Hopefully it was helpful. Have a great day.